P/E ratio. It sounds complicated, but it's really simple. The P stands for price, meaning the price of the stock, and the E represents earnings, which is the amount of profit per share of stock. So, for example, if the current price is $54.96, and its EPS, or earnings per share, is $4.30. When we divide 54.96 by 4.3, we get roughly 12.78. This is our P/E ratio. The lower that ratio is, the cheaper the stock is said to be. No, the price for each share of stock doesn't tell us if it is cheap. When we purchase stock, we are buying a theoretical share of the company's profit. It's all relative. But the less we have to pay per dollar of profit, the better. It should be noted that P/E ratios are only useful for stable, profitable companies. Companies that lose money will not have a P/E ratio. So, what is considered a good ratio? That depends on the industry and how fast the company is growing. For fast-growing companies, people will pay more for the earnings. This is because the market expects its earnings will rise quickly in future quarters. So, for high-growth stocks, even P/E ratios well over 100 may be acceptable. But for slow-growth companies, you generally want P/E to be under 30. In certain industries, like telecommunications, something around 10 is the norm. However, in others, such as technology, a P/E around 30 may be typical. Your best bet? Compare it to similar companies. This will give you an apples-to-apples way to evaluate which stock may be trading at a discount.